Thank you, Melissa, and thanks to everyone who's joined the call. Like Melissa said, the National Investment Fund and the bonds being issued by the fund is of paramount importance right now in Trinidad and Tobago. And so I thought it would be useful to have a discussion and get some clarity. The first thing I want to say before I introduce my two brilliant guests is that, first of all, this webinar is not to be construed or interpreted as anyone giving investment advice per se. This is for discussion and to get clarification and understanding of what this is about. I would suggest that anybody who's considering investing in these bonds, they need to have independent and professional investment advice before you make a decision either way. And so this is not advice. The other thing I want to highlight is that, I have been asked in the past many times to give people my idea of my sense of whether these are good investments. And on this webinar, I will not be giving, and I have never given my opinion as to the appropriateness of these bonds as an investment, because I'm an economist, I'm not an investment advisor. But we do have on our call Nigel Romano, who is the managing director of JMMB Bank Trinidad and Tobago Limited, a seasoned banker, and Nigel is very knowledgeable in all things finance. So he's going to share his views with us. And I also have Brent Salvary. He is the Director of Portfolio Management at KSBM Asset Management. Brent, again, in the field of finance for a long time, and so will be one of the best people qualified to give us the answers to some of the questions that I know those of you on the call have sent my way over the past few weeks. And so very thrilled, guys. Good morning, Nigel and Brent.
Morning.
Good morning.
Good morning. And thanks for agreeing to join. It's lovely to have you. And we look forward to the discussion. I look forward to having this debate with both of you, as well as to hear what questions we have from our audience. The first topic we want to talk about, as per the email, is why the National Investment Fund and why now? And the first thing I want to make clear is that the fact of the matter is the government has a fiscal deficit, meaning that they don't have enough revenue to cover their expenditure. And so they have to raise money to finance this deficit. The Minister of Finance had outlined in the budget the ways in which he's going to finance the deficit. One was through drawdowns of the Heritage and Stabilization Fund. One would be through borrowing, and one would be through one-off capital items, financing items. And so these NIF bonds are not a surprise because they do constitute one way in terms of borrowing to finance the deficit. I now turn over to Nigel and Brent for them to weigh in on this question. Why the NIF and why now?
So I take your point that the government has a deficit to finance. Mm-hmm. And some commentators have said that they should sell some of the assets that they acquired from the CLICO bailout instead of borrowing against it. Personally, I believe that to sell good assets in a downturn, in a time in the economy when those assets could be worth less than they had been worth, does not make much sense. So, for example, one of the biggest assets in the pool are the Republic Bank shares. And those Republic Bank shares are now trading 14.5% below what they were trading for in January 2015. And we're talking at the current prices, or the prices that are included in the prospectus, the values that are included in the prospectus. If we increase those prices, we are looking at something like $643 million. The Whitco is down 31.5%. That's a smaller share of the assets. OCM is down 49.5%. And Angostura is just about at the same level it was on average since 2015, when it had the highest. Therefore, to borrow against these assets makes sense, because as the economy improves, you should expect the value of the assets to move up, and the shareholder, the corporation sole, and the people of Trinidad and Tobago through the corporation sole to benefit. And therefore, for me, this is a very, how should I call it, an elegant solution at this point in time.
Okay.
Brent.
Sure. Well, Nigel, I think Nigel mentioned the pertinent points. In terms of timing, this is probably not the right time to sell the assets. It's also a good time in terms of investors trying to diversify the portfolio. In terms of bonds, they hardly have any good quality bonds on the market. So this presents a nice opportunity for them in terms of the risk and the return. So it's having a cake and eating it too, in the sense of you're getting funds from the assets, but you're not selling the assets and you're retaining ownership. So it's a pretty good solution. But you have to go back to the beginning when we were first told that this was going to be an equity fund, something along the lines of NEL, and then it changed abruptly into a bond, and then they had HCl and methanol in it. Those were the initial assets, along with the ones that we have now. And then it changed to TGU. We got rid of methanol and HCl. So I think generally investors were a bit put off by that initial sort of change.
Right.
And I think now they've more accepted that, okay, this is a good opportunity. Again, the government has the opportunity now to eat its cake and have it too, since they retain the ownership of the assets. I think the only head scratcher that I have is, why include TGU in it? TGU is a perfectly good asset. I know what they did in terms of topping up the collateral with it, and of course buffering the coupon payments, the dividend stream, immediate coupon payments and principal. But TGU is a perfectly fine asset owned by the government, steady stream of income in US dollars. So that was the only part that I was a bit, not too with in terms of understanding why it was done. But otherwise, I think the investment is a good one.
And to your point, Brent, I mean, yes, we were told in the budget initially that, units in this National Investment Fund would be sold. And as a matter of fact, S&P mentioned it in their last rating report for Trinidad and Tobago, that they commended the government for using that approach as opposed to borrowing. Now we're borrowing, and we weren't really exactly told why. Does either of you gentlemen have a sense as to why this route was chosen in terms of issuing bonds against the NIF assets as opposed to selling units in the NIF assets? Perhaps it could be that, as Nigel mentioned earlier, the stock market and these underlying assets have not really performed well on the stock market since 2015. And perhaps also given what happened with First Citizens APO, there might have been some trepidation around, issuing on the stock market equity. What is your sense as to why this different approach?
Well, I think one aspect would be whether the market could have absorbed such a large amount of shares in terms of Republic Bank coming back to market and these spot traded companies. So we already have, I'm sure most of the institutional investors, beyond life insurance companies, pension funds, have large exposures to these traded companies. So the question would have been, would they have been able to position to actually buy more and create an even bigger position, exposure, especially Public Bank. That's a very widely held share. You have CIF, the Investment Fund, with 75% Republic Bank shares. So again, would portfolio managers be in a position now to actually increase the exposure to these stocks? I think that was one issue that we would have to look at, the liquidity in terms of, the more the risk. You have people who look at bonds as being more safe than equities. So therefore, there'll be a greater appetite for bonds compared to equities.
Okay.
And I think Brent has captured it. I think there is less risk in the fixed income instrument, and the whole question of the quantity of shares coming onto the market at this time could have also depressed the value of the offering. In this case, you have certainty with respect to the cash flows that you can expect, and the rates are there: 4.5, 5.7, and 6.6, depending on the tenor. And I think it's a much safer investment for both individuals and institutions. The other thing for me is that the other risk I think they would have had to take into consideration is the whole question of concentration. The government wants more people to invest, and therefore going to equities where people have less experience could have resulted in those equities being held by a smaller group, if you will. So for me, those are two of the considerations.
Gotcha. And Nigel, you just mentioned something there about the rates on these bonds. What are your thoughts on the coupon rates being offered on these bonds? Do you think that they are attractive enough? Do you think they're too attractive and the government left taxpayers' money on the table? What are your thoughts? And also, Brent, your thoughts as well to follow.
Yeah. So I've seen the argument that it's not attractive enough, it's too attractive. So two things to take into consideration here when it comes to looking at interest rate. One is the duration. So here we have 5-year, 12-year, and 20-year bonds, and they are not amortizing. And what I mean by that is that principal is not being repaid over the period. So the 5-year bonds are bullet payment at the end of 5 years. The 12-year bond are bullet payment at the end of 12. And the 20-year, of course, a bullet payment at the end of 20. So you have to compensate, and it's fixed rate. So you have to compensate investors for accepting a fixed rate investment over that period. I looked at some of the paper in the market, and I'm not going to call names, but in one case, we had an amortizing 10-year bond. So a duration in effect of 5 years. And that rate was paying 6.25%. This is a private sector instrument. We have another 2024 6-year bond paying 4.5%. But again, so when you look at that, when you look at the duration, we have here 4.5% for the 5-year, we have 5.7% for the 12-year, and we have 6.6 for the 20-year. So investors have to be mindful. If your intention is, as the accountants say, to hold to collect. In other words, you are holding, you are going to collect your interest payments, and at the end of the term, you're going to collect your principal. Then there is no price risk, there is no valuation risk. The only risk you have there is a default risk. If you want to sell, you will have to take into consideration the fact that at the time of sale, depending on interest rates in the market, the value of the bond could be lower than the promised payout at the end of the term, because you have to compensate somebody coming in for the rate in the market at the time that you want to sell. So for me, these rates are not unreasonable. They are comparable to the offerings in the market. And, it's always a tough call. Maybe we could have pulled back a little more. Maybe we could have offered more. But again, I'll let Brent kind of opine on that piece.
Well, I think the rates offered are very attractive, given the risk. I think if you look at the collateral is twice times over. So you have a pretty sizable cushion there in terms of any negative impact in terms of the underlying assets. The coupon payments can be readily be made by the dividend stream. There's an excess of at least 1.6 times. So the coupon payments are relatively safe. Your principal payments, well, most bonds, sovereign or corporate, are never really fully paid off anyway. They're more or less rolled. So default risk in terms of time of payment, even though there's a sinking fund that will pay part of the principal when due, even though there's a shortfall there, when we do our calculations, there is a shortfall. But most likely investors will roll that bond, or they'll be able to issue additional bonds to make up for that maturing principal if there's a shortfall. So given that risk profile, I think that the rates offered are very attractive compared to anything in the market, and I would definitely consider it.
Okay, and thanks, guys. I mean, what Brent you just mentioned there in terms of the risk profile segues nicely into the next question I wanted to get to, which is, well, I think you both outlined what are the potential benefits. If there are any others you want to highlight, please do. But I wanted to have a discussion now on the potential risks. Nigel, you also touched on some of the potential risks with respect to price movement. The fact that interest rates are going up now in the market suggests that the price for the bond, there will be downward pressure on the prices for the bonds, and such that anybody who wants to sell on the secondary market after they're issued, there is a chance that they can face a lower price than they paid for. Now, there are other risks that were outlined in the prospectus, which I believe everybody needs to read and everybody needs to get a proper understanding of what these risks are: market risk, interest rate risk, credit risk, and so on. I would just want to hear from you both. What do you think are the more serious risks facing any investor with these bonds?
Well, the point is that the bonds are secured by a debenture over the equities. And the dividend streams, as Brent pointed out, are sufficient to cover the interest payments without a problem, leaving about 109 in a worst case scenario where you have no 5 years issued and you only have 12 and 20 years issued. You would have about $119 million a year going towards the principal payment. If you take that $119 million and invest it at a return of 2%, you would end up with about $2.9 million at the end of 20 years. And if you get 2.5%, you'll end up with $3.1 billion. So at the end of 20 years, you would have to look for another half a billion dollars, assuming that the investment is not rolled. That's not a huge amount. And remember, again, you have equities backing the investment. So for me, as Brent says, you have a really good investment, well secured, and as he said, I really don't see the risk, and as you said, there's always risk. So let's talk about price risk. If the price drops, what that means is that your return will drop. If you have invested in the 5-year bond at 4.5%, after tax you're looking at 6.43% if you're in the 30% bracket, as most of us are, then your return may drop to maybe 5% after given the tax effect. So is that a risk that is unreasonable? Is that a risk you want to take? I would. And therefore, that's how you have to consider the investment. So the price that you will get if you cash in early, cash in before maturity, would depend on the interest rates available to similar investments in the market. Therefore, at that point in time, you have to decide what would be the impact on my return, and make your decision based on that. But so it's not that you're going to lose, it's that it impacts the return on your investment.
Okay.
Brent?
Yeah, with regard to the culture in Trinidad, bond trading is not something that is on, everyone's to-do list.
Repertoire.
Yes, we don't trade bonds very often. Even institutions don't trade bonds very often.
They buy and hold, right?
Balance, correct.
Like
So
land.
exactly. So the market risk and price risk is something that market risk is probably the biggest risk, in the sense that the underlying assets trade on exchange and are exposed to swings in the exchange. So when the exchange, the market falls, the asset value will fall, the collateral value will fall, right? So you have that risk. But in terms of the bond itself, interest rate risk, that only applies if you're going to sell the bond, which I said highly likely. There's liquidity risk, the ability to actually trade it on the exchange. And again, given the lack of a trading culture in Trinidad and Tobago, that really wouldn't really be taken into consideration. And interest rate risk, which Nigel touched on, in the sense of when interest rates move, in this case, when they increase, the price of the bond will fall. So, and that only applies if you're going to sell. So really and truly, the only risk that you're going to look at is default risk, and we've covered that in the sense of adequate coupon coverage, sinking fund to address the principal payments, and additional bonds could be issued for any shortfall.
And if all else fails, you have the equity as your backup.
Correct. If all else fails, and then this is an SPV owned by the government, so.
Right. So again, Brent, you're doing such a good job of segueing, if that's a word, into my next, which was, I wanted to highlight what are the important issues related to this NIF. And what I wanted to highlight, which ties into the point that you all are making around default risk or credit risk, which is that should we get to a point in time, say 5 years, 12 years, or 20 years from now, where the government, well, the NIF in the first place, but then also the central government may not have the wherewithal to honor the principal repayment. That is, to me, my concern is that we have a government that is running a fiscal deficit again, and I don't know, unless I'm missing something, what is really the fiscal plan, the fiscal response, the fiscal framework to balance the budget anytime soon. And so my concern is that, are we lending the government $4 billion this year? And then potentially we have to do the same next year. Now, I know that's a hypothetical question, but insofar as we do not have a fiscal framework and a medium-term fiscal plan that suggests when we're going and how we're going to balance the budget, we can reasonably assume that we're going to continue with fiscal deficits for the next few years. And let's be frank, the closer we get to a general election, the less likely it is that the government is going to reduce expenditure. So my concern is that we are raising debt yet again. As we know, our total public sector debt is about 121 billion TT dollars. And we have a primary fiscal deficit, which means we are borrowing to service the interest on the existing debt. And we don't have a plan to fix this problem. So my concern is this is an instrument, or these instruments are being put on the market now to help finance the deficit today, this fiscal year. What's happening next fiscal year? And if we continue like this, that raises the risk of default, in the sense that as you borrow more and more and more, and you are borrowing to service the interest on your existing debt, it leaves you with much less room to wiggle. And in 20 years, 12 years, we don't know, it is possible we could find ourselves in a position where we don't have enough money to service our debt, and we find ourselves in a debt crisis. That's my underlying concern with this. I'm willing to be schooled and to hear your thoughts on this matter.
I let Brent go first this time.
Okay, well, Marla, I mean, that's that's a valid concern, a very valid concern that you have. But in terms of debt and local currency debt especially, government local currency debt is basically risk-free. They would hardly ever default on a local currency bond because there are a couple options. If there is a shortfall in revenue or any other source of raising revenue, they could raise taxes and they could print money.
Brent, may I stop you there 1 second, please? Try telling a Jamaican that local currency government debt is risk-free. They've had 2 restructures, as you know. Try telling a Bajan right now that local currency government debt is risk-free. They are facing haircuts on local currency debt in Barbados. I disagree with that argument. Technically and in theory, it's risk-free because the government can supposedly print local currency. Once you're not in a currency union, you can print, but we have seen in this region, our 2 neighboring countries, that you have had restructures on local currency debt.
Those extreme cases, though. I mean, Trinidad is, I mean, I understand Trinidad, I mean, our GDP, debt to GDP is around 70–80% compared to Jamaica, which is close to 200.
No, it was 147 at the peak.
And Barbados around there also.
Right now, about 175 debt to GDP. Right. But Barbados also thought they would never get here. Agreed. You know?
Agreed. But I mean, in the short term, I think, you know, we could still regard local currency government debt as risk-free. I think for argument, I understand the point, definitely. There is a possibility of going down that precipice in terms of having to restructure. But I normally like to think of government that is risk-free.
Brent, is any investment really risk-free, ever?
There are parameters, and once you cross those parameters, then you go into the unknown. And that's when the debt to GDP obviously gets out of control, which has happened in Jamaica and Barbados. But I think in terms of the context in Trinidad, we are a bit far off from that right now.
But we have a primary deficit. We're borrowing to service interest on existing debt. So that is a measure of unsustainability.
Correct. Yeah.
Nigel is dying to jump in. Come on, Nigel.
So I understand your concern, but I want that, I mean, so you're into the hypothetical. I agree with Brent that Barbados and Jamaica were extreme cases, and we are a ways from that. We could get there with imprudent management, but I don't think we are even close to that at this point in time. And the good news about, for me, in this particular structure is that the debt is ring-fenced. The government has put the assets and secured the debt with those assets. So again, there is risk that those assets can fall in value. But there is also, given where we are, and as I said, given the fact that the assets are now trading in some cases significantly below the highs of the past 5 years, the likelihood is that there could be increases there. But we're talking risk. And the other risk is the dividend stream. Dividends are discretionary, and the company can choose to pay or not to pay. However, these are all companies on the stock exchange, except for TGU, and they have consistently paid their dividends. And again, we have the buffer, a buffer that where the excess can be put into the sinking fund and invested to pay off the debt, the principal going forward. So for me, in this particular case, the NIF is well structured and a very sound investment.
Okay, so I think now we've discussed, unless anybody wants to ventilate anything else, we've discussed some of the major issues and risks and benefits. Perhaps we could turn to now take questions from our callers.
Thank you, Marla. We have gotten a ton of questions, as you would probably imagine. I'm just going to start off, and I'm going to consolidate some of these so the people on the call can understand that if I don't ask your precise question, we will try to get them all in as best as we can. To start off, Marla, why would the government issue these bonds at such low subscription levels of TTD 1000 each? This is unusual and maybe the first time.
Okay, that's an interesting question.
Go ahead.
I just want to say that, okay, I noticed that, and I mean, the government is saying that the reason that they issued these bonds is so that the citizens of Trinidad and Tobago can hold a piece of these assets and the nation's patrimony, et cetera, et cetera. However, I mean, these assets were already owned by the central government, and so therefore, indirectly, all of us, all citizens of Trinidad and Tobago, already own these assets. So that could be why, that they want participation from, as wide as possible participation from the quote-unquote layperson, man in the street, who will not be able to afford higher subscriptions of, let's say, 10,000 TT or 100,000 TT. So that's my sense of one of the reasons. However, being a conspiracy theorist as I am, I recall in Barbados a few years ago, there were these savings bonds issued at 5-year paper for yielding 5.5%. And the reason that these bonds were issued in Barbados was so that the government can raise money to finance its deficit rather than print, which is what it was doing to finance its expenditure. And one of the reasons why the subscription rates were so low, similarly in Barbados, was, I think, so that when you get this wide participation from lay people, the man on the street, these are unsophisticated investors, and probably at the time in Barbados, and I'm not saying this is the same in Trinidad, at the time in Barbados, even a former prime minister came out and spoke out about the risks, and that the reason why the subscription rate was so low there is so that the lay person, the man on the street, will not understand the risks and will not ask too many questions. They will just compare a 5.5% return on those instruments in Barbados versus what was being offered at the banks, and determine that, hey, I can get 5.5% for lending the government as opposed to getting 1% at the banks, and therefore that's what I should do. And so you had wide participation in those instruments from the average person. So those two reasons are what I think explain the very low subscription level. I'm, again, willing to be schooled by Nigel and Brent.
No.
No, I think I'm muted. I think you're right in that this allows people with smaller amounts to invest, to invest. And as I said before, given the structure and given the security backing the bonds, I don't think people should be too concerned about default risk. Brent.
No, yes, I agree. Just greater participation. I think that level allows for a lot of people who might not ordinarily be interested in bonds to at least look at it and consider it.
Agreed. And however, these are the people that are at the greatest risk of maybe not examining properly their risk profile, their risk appetite versus what these instruments represent. Because generally, people with the smallest amounts to invest don't have access to an investment advisor like you, Brent, or Nigel yourself. So perhaps I think that is, I don't feel so, and I feel it's a risk. So I feel that that's
hopefully they listen to this call.
Hopefully they listen to the call. I mean, I think we cannot overstress how important it is for people to get advice, because what might be a good investment for you, Nigel, might not be for me, you know, and that's a thing, that's a point that I think a lot of people miss. It's not universally no investment is universally suitable for everybody. You know, it all depends on your very individual and unique circumstances.
That's correct.
Yep.
Agreed.
Next question. Melissa, do we have any more questions?
I do apologize. I just lost power, so I was off for a few seconds. I apologize for the delay. Yes, we have a ton of questions.
Okay, good.
Okay. The second question, touching on the point that Nigel was making at the end of his intervention, can anyone guarantee that these companies will generate enough dividends to pay the interest and the principal when due? What if share prices go down, profits decline, or even there's losses by the companies?
There are no guarantees. What risk is about uncertainty. And in evaluating, and again, I would recommend, as Marla says, that people interested in investing read the prospectus. It's a very good document. And also read the Carrie Chris report. It's a very good document. And then if they have questions, they should approach their investment advisors. The point is that there are no guarantees. I mean, I can walk out of here today and die on the pavement in the next 10 minutes. Heaven forbid, but there are no guarantees. All right? The point, though, is that based on track record, you have Republic Bank, you have Whitco, you have OCM, you have Angostura, and you have TGU, which are quality companies with a stellar track record. So that so in accounting again, we talk about the probability of default. So what's the probability that Republic Bank's dividend would drop precipitously, or all of them combined, so that they don't meet the payments? The Carrie Chris report is very clear about that. They have actually stressed that is reduced their assumptions and looked at what would happen if those dividends were to drop by X amount. And they still would be able to meet the interest payments and the level of rolling. And when we say the rolling the 5-year bond, so at the end of 5 years, the government says, okay, we're going to issue another 5-year bond. However, it's very clear that investors in the current 5-year bond are going to be paid off and have the option to go into the new 5-year bond. So again, that's how you look at it. But there are no, we can't say for sure what will happen in the future.
So, and just to add on what Nigel said, remember TGU and Republic Bank make up over 80% of the coupon,
yes,
the dividend stream. And those are two stable companies in terms of TGU supplying 50% of the electrical energy to Trinidad, Republic Bank being the largest bank in Trinidad. And you know, a track record of stable dividends, stable profits, and so forth. TGU profits came down a bit, and that was because it issued a bond last year, but it's going to be pretty much steady stream here, around 20 million a year US to the government in dividends. And so once you have that steady stream, and the dividends as it is, when using 2017 figures, cover at least 1.6 times the amount of coupon payments that's needed to be paid. So there is that cushion there, that there is, you know, these dividend streams can cover the coupon payments fairly easily.
Next question.
Just following up on that, there's a few questions regarding what if the NIF cannot repay interest and or principal? Who takes the loss? Is it the bondholders who takes the loss?
Yeah, that's a question.
So the question is, how does the NIF repay? Its primary source of repayment are the dividend flows. And as we said, these are solid companies, good track record, and those dividend flows and the reinvestment of the excess in the sinking fund should cover about $3 billion of the $4 billion over the 20 years, depending on the timing. So you have $1 billion left, which, as Brent says, you can refinance and the government can roll. However, if the worst happens and the dividend stream dries up, they sell the assets. The bond is secured by the equity. So at that point in time, and hopefully you would have the time to liquidate in an orderly fashion, so that you realize the biggest bang for your investment. And as I said before, you do not want to sell your bonds in a depressed market. That's what, you do not want to sell your shares in a depressed market. That's when you buy. You don't sell when the market is, when the economy is down. You look for buying opportunities. In the same way, if you own, you should hold on and wait for the economy to correct itself, at which time the equity should increase. So for example, if in 2008 you had equities, that was the worst time to sell because everybody was running for the exits. You should have been buying.
I think that's a complete
It's a lot
answer.
of courage, but that's what you need to be doing.
Hindsight is always 2020. I mean, I want to just add to that. I think what the person who asked that question is getting at is, should the NIF be unable to honor its obligations under these bonds, what happens? And like any other state-owned enterprise, I guess we can ask the same question about Petrotrin and the 850 million US bond that's due next year. You have a central government that can potentially step in and honor the obligation. In the case of a TT dollar obligation like the NIF bonds, as Brent outlined, the government can print, right, and honor the obligation. So I think the answer to that possibly we can put forward is that should the worst happen, you have the central government to fall back on, even though there is no explicit government guarantee for these bonds. That's my take on it.
I mean, the recourse.
Go ahead, Brent. Go ahead.
But I mean, most bondholders would have recourse based on the terms and conditions in the covenant set out, in the trust deed and so forth. Mm-hmm. So that would dictate in terms of what courses the recourse they can actually take. Mm-hmm. So whether it be litigation or whether it be breaking up of the assets and the sale or whatever, there would always be some level of recourse for bondholders.
If there's a default.
If there's a default, correct.
My point was that before it gets to a point of default, the government can step in if they want to, the central government. Yes.
Absolutely.
Yes.
Absolutely.
Next question.
For me, the other consideration is that given the quality of the assets, the probability of the government having to step in and inject funds into the NIF is remote because of the quality of the assets you have backing the bonds.
Because of the same point, Nigel, Brent as well, because of the quality of the assets, which you've both commented on, I have a lot of people asking, why not invest in the shares? Why would people be better off to invest in the NIF than investing directly in the shares? If you could comment on that.
Well, as again I said, investing in the shares would mean the government would have had to sell the shares. And selling the shares at depressed prices makes no sense at this point in time. Here you have the opportunity to earn a more certain return as opposed to investing in shares where you don't know where the price is going to go. It most probably will go up, but the government doesn't want to give up that upside at this point in time. So on behalf of the people of Trinidad and Tobago, it's borrowing against the asset and with the expectation, and for me, not an unreasonable expectation that the price would go up.
Yeah, I mean, again, too, the risk factor in terms of the market's ability to absorb all those shares is a big question. I mean, that's $4 billion in a pretty small market as Trinidad and Tobago. That's a lot to be absorbed without, as Nigel said, in concentrated or by, in concentrated amounts.
Next question.
What happens if the TTD is devalued? Would the NIF bonds lose value? Who would lose the value in that case?
In a case like that, any asset that you hold in TT dollars will now be worth less in real terms. Anybody want to care to elaborate on that?
Well, I mean, I understand your real terms argument. The point is that TGU is a US dollar earner. Republic Bank has significant interest outside of Trinidad. So in those cases, Angostura trades internationally and would have export earnings. So in a situation like that, I would expect that the profits in TT dollar terms to be positively impacted. Of course, you would have in US dollar terms a difference, a decline in price, but you are investing TT dollars. So
yeah, I mean, your two biggest owners, the TGU operational, but their balance sheet is US. Their revenues are in US. As I just said, Republic Bank has a fair amount of US inflows. So that would balance off Angostura, a lot of sales outside of Trinidad. So that would balance off any sort of devaluation or depreciation of Trinidad dollar against, and probably increase the cushion in terms of the collateral, in terms of the dividend stream, in terms of TT dollars.
The next question, and I don't want to get too much into each one of the assets that makes up the NIF, because I'm getting a lot of questions, but I think that this one fits in very nicely regarding Republic Bank specifically. What does Republic's exposure to Barbados look like in a potential restructure in Barbados? What could that mean for the quality of that asset in particular?
I just want to respond first, please. Now, you have a massive debt restructure being negotiated in Barbados, and we know that that Republic Bank has operations in Barbados and has an exposure to the government of Barbados. I am not sure if they also have US dollar exposure or just local currency Barbados dollar exposure, but in any event, this debt restructure is likely to mean that the profit and loss, as well as balance sheets of all the banks in Barbados will be affected. So I imagine there would be some hit to Barbados, to all the banks in Barbados, sorry. But if you look at the financial stability report of the Central Bank of Barbados, all of the banks in Barbados are very well capitalized, if not overcapitalized. And so it looks as though they will be willing to withstand some measure of a hit coming out of a debt restructure in Barbados. And that's my overall macro take. I can't comment on a micro basis on Republic Bank's position specifically in Barbados. Perhaps Brent or Nigel, one of you might want to comment.
I mean, the exposure to Barbados to Republic Bank, I know there is. I can't remember off the top of my head how large it is. It's no larger than 10%, I would imagine. So the hit there would be, I don't think it would be that significant to really affect Republic Bank's profit and performance on a whole. There would be a one-off sort of transaction that you have to write down assets. But on the whole, I don't think it's going to be a significant hit.
And I don't know how much the exposure is, but I would be surprised if it were not already provided for somewhere in their financials.
If they didn't already write down and take a loss on, yeah. I would be as well. I would be surprised as well. So I guess next question.
What happens if the NIF is undersubscribed?
That's a good question. I did pose that question to the Minister of Communications last week on that CNC3 show. I think that their position, the government's position, is that it will be oversubscribed. He said that it would be taken up by the government if it's undersubscribed, but they don't anticipate that outcome at all. Nigel, Brent?
Yeah, I mean,
I agree with you.
Yeah, I agree with you. I think if it's undersubscribed, it depends on which bucket, but I don't see any of the buckets really being undersubscribed. I think all especially long end, the institutional investors would definitely find the 6.6% yield on 20-year very attractive. The retail investors, the 5-year, they'll find that very attractive also. But in terms of being undersubscribed, then everybody will get basically what they want, and there wouldn't be any reason to prorate.
Next question.
Sorry, go ahead.
Did you want to comment, Nigel, on that?
No, go ahead.
The next question is, if interest rates rise during the term of the bonds from 5 to 20 years, wouldn't the yields from these bonds become uncompetitive?
Well, it depends on how much those rates rise, and I think they will have to rise significantly to become uncompetitive. Brent, you're the investment guy.
Right. So okay. So once interest rates rise, that therefore the bond price will adjust to reflect the new level of rates in the market. So, for instance, the 5-year bond, say for instance, as soon as the bond is issued and interest rates rise 1%, right? Therefore, bonds of that quality would have to yield 5.5% instead of 4.5%, and therefore the price would have to adjust to get that yield to 5.5%. So they will have a negative impact. And the longer you go out in terms of maturity, the greater the impact. So a 20-year bond, in terms of interest rate movements, will have a greater risk than a shorter term bond. Hope that answers the question.
And I think as you approach maturity, the risk decreases, or the impact of the price
On the prices, yes.
adjustment will decrease.
Mm-hmm.
I'm going to break towards another type of question that we've had, which is specific to Marla, and then we'll come back to the NIF discussion. But I've gotten a lot of questions around, Marla, that this is an unsustainable option that the government's chosen. That's an opinion, of course, to finance. But the point is, it's to finance a shortfall in revenue. So the question becomes, how would you suggest the government go about cutting some of its expenditure? What would be the best way to actually address in a sustainable way the shortfall between revenues and expenditures? Could you comment on that, please?
Yeah, that's a broad question. I mean, the thing is, in the first place, we need to have a medium-term fiscal plan that outlines what right now as far as I know, we're operating in 6 month, if not 1 year fiscal time frames, which really does not allow for you to have any kind of longer term view. And most reforms or most policy changes take time to yield benefits. Therefore, having this very short view doesn't allow you to say, for example, let's have a view that we want to cut the public sector, the cost of the public sector wage bill. Wrapped up in that would be an agenda for public sector reform, maybe a shift to e-government, and those kinds of reforms. Those are the things I'm saying when I say that we don't see a credible plan to make the fiscal situation sustainable. I feel that that's what we need to have in the very first place. We need to have 3-year, 5-year plan that looks at building sustainability into our fiscal management, which we do not have in Trinidad, and I don't think we ever have. You would see that Jamaica and Grenada, for example, have shifted to a fiscal framework that builds sustainability in and builds balanced budgets for a longer period of time so that you don't have to increase your debt. I would like to see the government cut spending on transfers to loss-making state-owned enterprises. I would like to see the government address, for example, Petrotrin, and the big drain that Petrotrin is, not just from a fiscal standpoint, but also, as we have heard recently from the chairman, that it is also a net user of foreign exchange. I would also like to see the government address, as I mentioned earlier, the size of the public sector, the wage bill, and the efficiency of the public sector via a public sector reform agenda. Those are the major things I would like to see to bring about fiscal sustainability so that we don't find ourselves in this situation every year of trying to find money to finance a deficit. Brent or Nigel, either of you want to add anything to that?
Well, one side of the equation obviously is cutting expenditure, but you also have to increase revenues. And there's really no, as I said, no real clear plan in terms of how we're going to do that. We're still very dependent on the fossil fuels and the revenues from that sector. So that is one part of the equation, cutting expenditure, which is always going to be a very difficult thing to do, given the volume in which it has increased over the past decade or so. So cut expenditure is going to be very painful.
So for me, and I agree with Brent that we have to focus. I mean, the expenditure cutting is necessary and not easy. So I am so happy that I am not the one having to make those decisions. On the revenue side, I believe that we need to work with the regulators, to work with the organs of state that impact business, the customs, the revenue authorities, the registrar of companies and that kind of stuff, to make it easier for young people and anybody else, quite frankly, to start businesses. We need to be looking at incubators and accelerators to encourage entrepreneurship. And we also need to focus on getting that junior stock market going so that young entrepreneurs can find a way to monetize their ideas. And there are a lot of ideas, a lot of bright young people trying a whole heap of stuff that we need to encourage. And that's an area that I think the government should spend a little more time in.
So Nigel, you are alluding to a private sector-led growth strategy, and in a private sector-led growth strategy, the revenue that you alluded to, Brent, will come from the taxation of a bigger and more successful private sector.
Absolutely.
Well, you see, the taxation piece, let's put that aside for now. It's the generation of jobs. It's the generation of export-led. I mean, and it will start small, but we should see it grow. But we have to get people, we have to cut the umbilical cord. A lot of people you talk to come and say, well, what is government going to do for me? For me, that's the wrong question. The question is, how can the government facilitate, not fund, but facilitate my ability to do business by basically getting out of the way?
Brent, no, you wanted to add something?
You look at customs, you look at how much it costs to register a company, how long it takes. You look at things like land registries and that kind of stuff. We want to digitize all of that. We want to make it easier for people to quickly know, well, you know, I can get this, I can get that, and I can move faster. We want to look at the whole payment system and get that much easier to transact and do business than having to worry about checks and that kind of stuff. Those for me are some of the things that could get commerce moving and encourage, I mean, small entrepreneurs. All right, make it easy for the doubles vendor and the fruit vendor to run their business and not have to run to a bank to deposit money or take out money. That kind of stuff.
Right. Brent?
Well, I mean, it's part of such a larger question. And I think one of the biggest aspects that we have to address in terms of diversifying the economy is we have to look very differently in terms of how we do it, because we're looking at creating industries. But what industries are we going to create? How long is that going to take? What's the gestation period? What's the risk involved in terms of we do it wrong and we end up, wasting time and money? I think the approach has to be very different in terms of diversifying the economy. We have to buy into industries and not create industries. And Trinidad has to look at this on more of a private equity sort of outlook, as opposed to a country and creating industries that is going to take a long time. And whether we have the expertise or not is another question. But that's a much larger question.
Of course, we could do a whole other webinar on this question. I think too, but to your point on the revenue, Brent, I remember the minister in the Ministry of Finance, Alison West, speaking about improving tax administration that can actually, there was a study done that says that we can earn about 12 billion more per annum should we administer our taxes better, the existing framework, not including the property tax. And so I think in addition to the reforms that I mentioned, I think it's important that there be a focus on improving tax administration as well before we add on more taxes to an already weak system. But maybe we'll have another webinar on this topic. Melissa, are there any more questions that we can take? We don't have a whole lot of time left, and I don't want to keep anybody too much longer.
We are past 12. I will put forth one final question, and then I think you can turn it over to see if there's any final thoughts that the panelists would like to share with us today. The final question I pose to you is that no one can predict the economy over a 20-year period. How do elements like the forecast on inflation play into the investment for the various year packages, and what other factors do people need to take into account? And just extending on that a bit, is comparing this to what would be a corporate bond. A 20-year period would seem very risky. What if one of the companies in the portfolio goes out of business? So if you could just comment on the term of the bond and how that impacts and what other elements play into risk.
I would just say, yes, 20 years is long, and the longer you go out, the more risk there is, the more unknowns, as Nigel mentioned about unknowns. And, again, I can't help but go back to recent history in Jamaica and recent history present in Barbados, where I don't think 20 years ago Barbadians thought that this is where they would be. And so while to us in Trinidad, God is a Trini, right? So we don't think these things can happen to us. But I think that's really not the kind of position that I like to propagate, because I'm sure Bajans and Jamaicans probably think God is a Bajan and a Jamaican too. And, we're all blessed in our own ways. Now, I was kind of surprised about the 20-year tenor on that longest bond. And who knows what can happen. That's my position. I think in 20 years, anything can happen. But I leave it to these gentlemen to enlighten me.
Go ahead, Brent.
Okay, well, the 20-year bond, yes, the risk is going to be greater as the unknown, the uncertainty. But there are institutions like life insurance companies, pension funds, that could match their liabilities with these assets, these long-term assets. So that is going to be for them. The retail investors should look at the 5 to 12-year tenors, where it's more manageable in terms of time and risk, but leave the 20-year to the institutions who will find greater use for it to match their assets with the liabilities.
Exactly, and I think that's the bottom line. Insurance companies, pension funds have 20-year, 40-year, some 50-year liabilities that they can match these investments to their portfolios. So the 20-year is not for the individual unless you're a very wealthy individual and can live off the interest income.
Okay, so I think what we should do now is wrap up because we're over the 1 hour mark. I just would like to invite both of you to give me your closing remarks and any thoughts that you want to leave us with.
Well, thank you for having me. I think we've had a very good discussion. The thing for me, for us to understand is that here we have a situation not desirable by any means of the government having to fund a deficit. I think the government has cut into the deficit by, as you said, $10 billion. There's another 10 to go. And it's a difficult situation. But I also think that the way this has been structured, the assets that have been set aside to guarantee the obligation makes it a very attractive investment.
Okay.
Marla, also thank you very much for inviting me. I think from a purely investment standpoint, I think this is an instrument that is worthy of consideration for most investors. They would have to look within themselves or ask the question, what are their investment objectives? What is the time horizon? And so forth, to really see if these instruments match up with their requirements. But I think it's definitely worthy of consideration for most investors.
Okay, thank you so much, Nigel. Thank you so much, Brent. I know you guys are both very busy gentlemen, especially at a time like this when we have lots of people clamoring and knocking on your door, asking questions and asking about these bonds. You know, so I really appreciate your time and your expertise. And I think this is the only forum really that has publicly discussed these investments in this way. I just wanted to reiterate to everybody who's listened and watched how important it is to get your own independent professional advice, because your circumstances are unique, and therefore, you know, it would be better to take a full assessment of those individual circumstances relative to the opportunity that these bonds represent and the risks that they also represent. I want to also, again, thank our audience for participating. So many of them stayed online for well over an hour. And we really appreciate your participation and your questions. And of course, to thank Melissa for bringing us all together and doing this, pulling it off so beautifully in such a short space of time. Thank you. Thanks to everyone.